Well, why don't we get started? Thank you all for coming. My name is Ron Lake. I'm from Lake Partners. I'll be the moderator for today's event, which is another in our ongoing series of the Greenwich Roundtable. And first, I'd like to thank Vencast for sponsoring our event today, and also thank Steve McMenamin from Veracity Capital for help organizing today's event. And just as a bit of a backdrop, we're here at the Bruce Museum, here surrounded by a collection of Art Nouveau posters, and our panel, I'm sure, will talk about Art Nouveau, what's new, what's different, and where things are going. We had a session on the topic of arbitrage 4.5 years ago, and one of our speakers is sitting next to me, Fred Green, who I'll introduce in a moment. The other speaker was a fellow named Myron Scholes, who talked about his particular brand of arbitrage and described it as a process of vacuuming up neglected nickels. And I guess we'll talk about if there are such nickels out there today, where they are, and if there are any steamrollers right behind them or not. But without further ado, let me introduce each of our panelists. Sitting next to me again is Fred Green, who has over 25 years of experience in the investment world. After a stint at Kidder and at Goldman, he started his own company in 1980, Westchester Capital Management, which focuses on merger arbitrage. And he's also a co-portfolio manager of the Merger Fund, a mutual fund in merger arb, as well as a number of other partnerships and offshore vehicles. Next to Fred is Steve Bloom, who formed his firm, Sagamore Hill Capital Management, in 1999. And at Sagamore, Steve is responsible for a multi-strategy trading program. And previously, he was one of the 5 founding partners of Susquehanna. And seated next to Steve is Paulo Vicinelli, who is part of the arbitrage group at Gabelli Associates. Paulo's been there for 2.5 years, is responsible primarily for the European merger arb activity. And before that, he was with Langdon Capital, or Langdon Street Capital. And last but not least is Paul Singer of Elliott Associates, a firm that he started, I believe, 24 years ago. Is that correct, Paul? So he's been in this business for a while, and again is involved in a variety of arbitrage strategies, and including arbitrage and distressed types of investing. So let me start by turning it over to Fred and ask him to talk about, in particular, about where he sees the risks and the opportunities and the trends in merger arbitrage. Paulo, give us your view. Your focus is primarily on Europe. I noticed that Mark Gabelli just walked in the room, so no pressure.
Okay. Thanks, Ron. My name is Paulo Vicinelli. I'm with Gabelli Asset Management. I don't know that we've spoken here before, so thanks to Ron and Steve for having me, and I should probably just touch briefly on what we do. We have about $25 billion in assets under management at Gabelli, and that's divided into mutual funds, individually managed accounts, and the alternative investments area. And I work in the alternatives area. I help run the Gabelli Associates Fund, which is our merger arbitrage fund. As a firm, we've been in the arbitrage business for about 25 years, and we have a little bit over $1 billion invested in the strategy. In terms of our approach to the business, I think you would probably call it risk arbitrage with a valuation and research-oriented focus. We invest in both U.S. domestic and European arbitrage deals. As Ron said, I'm here to talk about European arbitrage. I thought probably to start just to talk about the recent history, maybe just the past few years. As most of you probably know, European merger arb is a strategy that has really come into its own in the last 5 years and has had huge growth. And that's largely a function of the explosion in merger activity in the late 1990s. If you look at some of the numbers in terms of merger activity from 91 to 95, European activity averaged about $150 billion a year. In 98, that went up to $860 billion, and in 99, it was $1.6 trillion. So the growth is really just exponential. It created, opportunity and attracted ARBs to Europe. And then in November of 99, there was a deal that we felt kind of changed European arbitrage. It was Vodafone's hostile offer for Mannesmann, which was Germany's largest mobile phone company. It was a very big, high-profile deal, cross-border deal, tremendously profitable for the ARBs. So what happened was the deal closed in January of 2000, and you had ARB funds up 2 to 3% for the month, really just on that deal alone. So what it did was it woke up a lot of U.S. ARBs and brought them over to Europe, brought more money into the strategy, and as Fred alluded to earlier, that tightened spreads. But in 2000, you still had a fairly vibrant merger environment characterized by a lot of cross-border deals. So the returns were still there, and then in the later half of 2000 and into 2001, you saw merger activity slow in Europe, as it did in the U.S., which brings us to where we are now in Europe. We think merger activity will pick up again, and that's really because the trends and the catalysts that drove it for the last couple of years are still there. The first thing that I would mention that we're seeing in Europe is an increasing sense of awareness for shareholder value on the parts of management, and that's something that I think is fairly new to Europe, at least in the last 5 years or so. One classic example of that, of a recent deal, is Sulzer Industries of Switzerland recently faced a hostile offer from its largest shareholder, Incentive Capital. And while Incentive didn't actually win the battle for the company, they did force a spin-off of the company's largest subsidiary. So you have the creation of shareholder value. Second trend is globalization. I mentioned we're seeing more and more cross-border deals, companies performing in a larger arena. You've had the breakdown of borders with the advent of the euro and the creation of the European community. And it's not just within Europe. You're seeing it between Europe and the rest of the world. Deutsche Telekom buying VoiceStream Wireless, Schlumberger of the U.S. buying Sema PLC of the UK. You could go on with the list, but basically just a need to be bigger to compete, driving merger activity. Then the third catalyst is the Federal Reserve lowering interest rates. The European Central Bank hasn't yet. It probably will, but what this does, it's injected liquidity into the system, and it makes cash deals much easier to finance. You've had a junk bond market for the last couple of years that has really been virtually shut off. So we think you're going to see more and more cash deals. And then the fourth thing I would mention is just in terms of Europe versus the U.S. The European economy seems to be more vibrant than that in the U.S. at this point, and obviously economic growth is one of the primary drivers of merger activity. So with that said, just to talk a little bit about returns and what we're seeing, last year in 1999 were very good years. We're probably looking at 15 to 20% annualized returns on a gross unleveraged basis. Since then, two things have happened, and I'll try not to overlap too much with what Fred said, but you've had a lot of money come into the sector because of the outperformance of arbitrage, and you've had that combined with a slowdown in merger activity, both of which have served to tighten spreads and the expected returns, which leaves spreads now, I would say, at kind of a low double-digit range, maybe 10 to 12% annualized, which isn't what it was, but I guess it's still attractive on a relative performance basis. One thing that we notice in Europe is that spreads tend to vary a lot. There doesn't tend to be a lot of middle of the road. We find that spreads are either very tight if it's a straightforward cash deal with no regulatory risk, and probably won't trade it wider than kind of a 7 to 8% return. But on the flip side of that, if there are, oftentimes it seems that there are risks that are perceived to be greater than they are in Europe. And if you have, a little bit of a wrinkle to a deal, sometimes the reward, the reward and the potential return that's offered really outweighs the risks in the deal. And then the second thing I would mention in terms of returns is that cross-border and especially transatlantic deals seem to offer greater returns. And I think an example of this is last year, two deals. AOL was buying Time Warner and Vivendi was buying Seagram. The two deals were virtually identical in nature, very similar in risk. Yet the AOL Time Warner deal never had a spread. There was never really a return to be realized there, while the Seagram Vivendi deal always did trade with a fairly attractive spread. Obviously, we had a position in Seagram Vivendi and not in AOL Time Warner, but it was. I think it illustrates the point that cross-border deals often do trade with wider spreads. In terms of risks in Europe, the big risk in Europe is that it's a more uncertain regulatory environment. You have two regulatory issues. One is the European Commission approval that's needed for some of the large cross-border deals, and then the other is the individual country approvals that are needed for certain deals. In terms of the European Commission, it's now run by a fellow named Mario Monti, who has a reputation, which I would say is well-deserved, of being a very tough negotiator, a stickler, and somebody who's not afraid to block merger deals, and has done so with a few fairly high-profile deals in the last few years. So I think in terms and how the European Commission will approach a deal. And that doesn't apply to just, quote-unquote, European arbitrage. If you look at a deal like General Electric's acquisition of Honeywell, whether or not that deal closes and goes through is really more dependent on whether they get the European Commission approval rather than the FTC approval in the U.S. So that kind of shows it's becoming really more of a global strategy, and regardless of where you're doing the arbitrage, you need to be in tune with the issues that exist in Europe. And then the other risk in Europe, as I mentioned, is just the individual country approvals. And oftentimes, merger law is quite undefined in the individual countries. Less so in the UK, but when you go out to some of, I don't want to call them secondary countries, but some of the countries where merger activity is more new, it's a more uncertain environment in terms of how the regulators will react and what approvals will be needed. While that does create risks, it also brings potential returns to the deal if you understand what the environment is. In terms of making money in European arbitrage, a few of the things that we focused on. The first I would say is to focus off the beaten path. As I said before, a standard tender offer in London is not going to trade with much of a return. Instead, we try to focus on countries like Spain or Holland or Italy, where maybe there's a little more uncertainty, but they're less ARBs focused. They're less money chasing the deals. The second thing I would say is knowing the regulatory environment. As I said, I think it's the biggest risk. Having local contacts in the countries, particularly if you're doing the arbitrage from the U.S., is very important. It really gives you more of a sense of how the locals perceive the deal and what the sentiment is there. And often that's obviously more important than what you're going to read on Bloomberg or in the newspapers. And then the third thing I would say is focus on European companies that are buying target companies outside of the U.S. in Europe. And that means Latin America, New Zealand, Australia. We've seen in the last couple of years some of the Spanish companies, the banks and Telefonica, the incumbent telecom operator, buying in its Latin American subsidiaries. Those have tended to be very straightforward deals with not a lot of risk, but fairly high returns. And another example is just this past month, Royal Dutch Shell completed its acquisition of Fletcher Energy, which was a very profitable deal. I think because it was in New Zealand, there weren't a lot of ARBs focused on it. Just to sum things up, merger activity clearly has slowed in Europe as it has in the U.S. Spreads are tighter and returns are not what they were 1 or 2 years ago, but it is still a viable strategy. We're still finding ways to make money in Europe. And I think that the trends that drove the merger activity in the late 90s are still there. Globalization and need to be bigger to compete, a breakdown of borders in Europe, and that combined with an increasing sense of shareholder value should lead to a pickup in the second half of this year. And we think more merger activity in Europe.
Well, thank you very much.
As Ron noted, the last time I spoke at the Greenwich Roundtable, I sat next to a Nobel Prize winner. The topic that day was the art and science of arbitrage. I guess Myron was representing the science and we were representing the art. And modesty forbids me to discuss which approach turned out to work better. I'd like to spend a few minutes on the current state of the M&A business, both from a quantitative and qualitative standpoint. And then I'd like to talk about some of the negatives and the positives that we see in the outlook for the merger arbitrage business. And I do have a handout which I'll be referring to during my presentation, and if you'd like to follow along, you're certainly welcome. The first chart that we have in the booklet shows merger activity in the United States over the last 10 years. And you can see that there's been a significant secular increase in the level of M&A activity. Last year, total merger volume in the U.S. Reached $1.4 trillion. That's roughly where it was the prior 2 years. However, in the first quarter of this year, merger activity ran at only about 1/3 of the level that it saw in the first quarter of the year 2000. What does deal flow look like these days? We have a number of pie charts in the handout which look at deal activity from a number of perspectives, and the first chart shows merger activity by type of deal, and by that we mean friendly versus hostile. You can see that friendly deals represent 91% of our portfolio, and by the way, all these statistics reflect the holdings of Hudson Valley Partners, which is our domestic arbitrage partnership, as of the end of March. It's not a perfect sample of overall M&A activity, but I think it's a close approximation. So 91% of all the deals in our portfolio are friendly, 9% are hostile. You might say, well, why are there so few hostile deals? And the answer is that most of the time they don't work. Most hostile takeovers end in failure. The target company sometimes gets taken over, but not by the company that initially launched the hostile offer. By type of buyer, we look at M&A activity by type of buyer in the next chart. And there we break it down between strategic and financial buyers. By financial buyers, we mean highly levered players, LBO firms. In the 80s, a very significant percentage of arbitrage activity in the United States involved financial buyers. That's changed dramatically in recent years, and as you can see, as of the end of March, virtually all of the arbitrage positions in our portfolio anyway reflected deals launched by strategic buyers, by companies generally operating in the same industries as the targets. Then we look at merger activity by deal terms. What are the target company shareholders going to receive if the merger goes through? And this pie chart shows that stock-for-stock deals involving fixed exchange ratios, for example, GE's proposed acquisition of Honeywell, represent 44% of our portfolio. Stock-for-stock deals involving flexible exchange ratios, where the ratio varies with the price of the acquiring company's securities, represent about 11% of our holdings, and cash and stock deals represent 15%. If you add those three slices up, you get about 70%, meaning that at least 70% of current deals involve at least some stock. Stock remains the currency of choice, even though the market's lower today than it was a year ago. There's some accounting advantages associated with stock deals. as well. All cash deals represent about 20% of our holdings. And then finally, we look at merger activity by economic sector. Where's the action, so to speak, in the M&A world? Telecommunications represents the largest segment of our portfolio at 16%. Deals like VoiceStream Wireless, which is being acquired by Deutsche Telekom. Financial services represents 14%, and what's really interesting about this chart is if you'd been here 4 years ago, financial services would have been far and away the largest segment, up to equaling as much as 40% of our holdings. There are fewer deals involving banks these days, and the deals that are out there tend to have such narrow spreads that they're not attractive to us. So the mix of our holdings has changed significantly. Consumer non-durables is the third largest category. Quaker Oats is being acquired. Ralston Purina is being acquired. A couple of deals in that sector. But you can see that merger activity is fairly well diversified among sectors these days. So that's what the current deal flow looks like. I'd like to spend some time on what I hope will be a fairly objective discussion of the positives and the negatives in the outlook for the merger arbitrage business as we see them at Green & Smith. So let's start with the negatives. And I think at the top of the list is that there are just too many people in our business. When I got into merger arbitrage 21 years ago, arbitrage wasn't a household name. You didn't read stories on the front page of the New York Times talking about what the ARBs were doing or how much the ARBs had lost or made in a particular deal. And now you do, and in a sense everybody's an ARB. You even have conventional portfolio managers who dabble in arbitrage. Their brokers tell them that if you want to buy GE, you can buy it cheaper by buying Honeywell, and their activity has tended to narrow the spreads in those kinds of deals. It's an easy business to get into. We say no black box required. In one sense, what we do is pretty simple. We go long Honeywell and we short GE at a ratio of 1.055 to 1, and if the deal closes, we make money, and if it doesn't, we lose money. I mean, the art of our business is to decide which deals to invest in and how big a bet to place on any given transaction and when to get out and what to look for in evaluating a deal. But on the surface, it looks like a pretty straightforward kind of investing, and it's attracted a lot of new players in the last decade, and there's a lot more money committed to our business. We talk here about commoditizing the business. Along with the growth of the arbitrage community, you've seen the growth of the arbitrage infrastructure, and I think this is really interesting. I mean, there are a lot of people out there, I sort of think of them as camp followers, who come and provide services and input to the arbitrage community. You have, for example, 3 major research services available on the Internet: Deal Analytics, Merger Insight, TakeOverStock.com, who provide their wares to the arbitrage community. Most of the member firms now have specific trading desks servicing the arbitrage community. So there's this huge infrastructure that didn't exist 20 years ago. And I think we all know that when a business becomes commoditized, that margins tend to come down. And I think that clearly is one of the negatives for the business. A second is the near-term slowdown in M&A activity. You recall that first chart that showed that we've seen a pretty sharp decline in deal activity recently. There's several reasons for that. I think it's pretty clear that we have a very murky economic environment. We don't know whether we'll go into a recession, and if we do, how quickly we'll come out of it. We talk about whether it will be a V, a U, or an L coming out of the downturn. So corporate managements really don't have a good feel on what the economic environment's likely to be over the next year or so, and that tends to put a damper on deal making, as does the need to stay afloat here. I mean, some companies are facing very serious near-term challenges in their businesses, and they have more important things to do than to make acquisitions. And finally, I think this is very important, is the disconnect between buyers and sellers. Sellers remember the prices they could have gotten 6 months or a year ago, and buyers are looking at today's prices. And until that disconnect is resolved, you're not going to see a lot of M&A activity. And the final negative here, and actually it's a product of the first two, is tight spreads on risk-free deals. Of course, there's no such thing as a risk-free deal, but there's some people out there, including conventional money managers, who might think there is. And we've seen, as I mentioned earlier, pension fund managers, mutual fund managers get into our business, and that's tended to narrow spreads. And some hedge fund players have decided that one way to take an inadequate return or a mediocre return on a given deal that's perceived to be risk-free and goose it into something more compelling is to use a lot of leverage. That clearly was the approach that long-term capital employed, and you still see a fair amount of that in the business today, and that tends to dampen spreads. Well, those are the negatives that we see. What about the positives? I think at the top of the list here is the improved regulatory climate. Bush appointees are taking charge in Washington, and if you look at some of the agencies that are important to arbitrageurs, like the Federal Communications Commission, for example, you have new blood there. Colin Powell's son, Michael Powell, is the new chairman of the FCC. He tends to be, I think, less activist than his predecessor, Mr. Kennard, and his presence at the FCC is probably a plus for our business. A more important agency, though, is the Federal Trade Commission. Mr. Murris at the FTC, I think, is going to be more deal-friendly than Mr. Potofsky. Mr. Murris apparently buys into the argument that corporate mergers can lead to considerable efficiencies, and when they evaluate pending deals, they're going to pay more attention to the possibility of achieving efficiencies through deals, and I think that's an important positive. Also, we think M&A activity is destined to recover rather smartly over the next year or so. The consolidation of corporate America is not finished. Foreign buyers continue to seek greater presence in the U.S. Calmer markets mean more deals. I think it's obvious. It's hard to put together a transaction against the backdrop of volatile swings in the financial markets. When things calm down a little bit, it will be easier to resolve that disconnect between buyers and sellers. Pooling of interest, which we had thought was on the way out this June, but probably will survive until the end of the year now. The end of pooling is not a deal breaker. It's not going to have a dramatic effect on M&A activity because it's replacement purchase accounting. The way they're tweaking the rules, you'll have a lot less goodwill created, or you'll have goodwill created, but you'll have less of a hit to earnings for the acquiring company because the acquiring company won't have to amortize goodwill against earnings. That's the principal problem with so-called purchase accounting. Under the new rules, goodwill won't have to be written down. Certain intangible assets will have to be written down, but we don't think that's going to put a damper on merger activity. It actually could be a positive. And then I think the final positive here, actually there are two more we can talk about, big spreads on deals with wrinkles. A deal with a wrinkle is a deal that has some obvious risk factor that part-time ARBs are probably not going to be comfortable playing, and they're also riskier to leverage, which means that there are some very juicy spreads available out there currently on deals that are viewed by at least some of the players as more problematic, and that's sort of become our specialty of the house. And finally, I think one of the negatives that we mentioned earlier, all the new players that have come into our business, could be looked at as a positive. I mean, we've been doing this for 21 years. We've invested in 1,500 corporate mergers and takeovers, and I'd like to think we've learned a few things over the years. We've seen great volatility in arbitrage spreads over the last year to a greater extent than I've ever seen in the business in 20 years. And the volatility of those spells opportunity. There are plenty of times when we can put positions on, take them off, trade around a core position, and take advantage of other players in the business who might be shaken out of a position because of some rumor that's floating around the internet. So we see an opportunity to play the players and to add to our returns as a result.
Thank you very much. Steve, give us your perspective on what's going on in the world of arbitrage.
Thank you, Ron. First, I'd like to, under the guise of introducing my firm to many of you who don't or aren't familiar with us, I'd like to slip in a promotional plug. But what we do is we've been in business a year and a half, and we're a multi-strategy fund. And we do convertible arbitrage, risk arbitrage, long-short trading, and a bit of distressed. And what Ron has asked me to talk about here today is our convertible portfolio. Convertibles over the past several years have had really tremendous returns. And before we I begin to talk about where those returns have come from and what we expect them to be in the future, I think it would be instructive just maybe to talk about what drives returns in a strategy like convertibles. From our view, in a strategy like convertibles, I think to understand the returns, it's best to focus upon really risk management issues, because there are so many different types of convertible arbitrage strategies that only in the context of what type of risk exposures does a particular fund have, I think, can you really understand where the returns have come from. Now, you often hear in a derivative strategy like convertibles that if you hedge all of your risks, you're left with no returns. Now, in a hypothetical, frictionless world, that's not true. That if you're selecting securities and finding securities that are undervalued, if you didn't have transaction costs, you could hedge all your risks away and be left with pure distilled edge or positive alpha. Unfortunately, and of course in the real world, this isn't really the case. The real world problems that get in the way are really twofold. One is that there are significant transaction costs involved with hedging those risks. And furthermore, I'm not embarrassed to admit that there's quite a bit of uncertainty revolving around what the best hedge and what the appropriate hedge is. So what you often end up with in convertible strategies are significant risk exposures. And, the real skill in determining where the return comes from is to separate what's the value added because the manager is finding mispriced securities, coupled with understanding what risks had they taken and had they gotten paid for taking those risks. And it's just curious, just a little bit of a digression, that I was thinking about the word arbitrage. And I didn't realize this, but the derivation is the Latin word arbitrare, which is really to arbitrate or to render judgment, which isn't quite the simultaneous purchase and sale of securities that I think of. But when you think about what arbitrage is in today's world, it really is in large part a judgment call. Judgment about what to hedge, how much risk to take. I won't take it to the next etymological step, and so if anyone wonders why it's related to the word arbitrary, but I think there may be something there. So it's clear that most convertible arbs are not fully hedged, and much of their returns do come from getting paid for taking certain risks. Now, what are those risks? What are the key valuation drivers in the convertible arb portfolio? They're really two significant factors. One is the volatility risk from the warrant portion of the bond, and the other is the credit risk that you assume for assuming the corporate credit risk. First, talk about volatility, and I can speak. I was speaking about our experience as much as talking about the world in general. As of course, that's what we're most familiar with. At our firm, we don't fully hedge volatility risk, and there are 2 points that I'd like to make about that. One is that for our strategies and our portfolio as a whole, we feel that we have some negative gamma or short volatility exposures. And to be long volatility through the convertibles and have that risk exposure, in addition to hopefully we're creating alpha because we're buying it cheap, we feel as a portfolio risk measure that it's actually a very good fit. In addition, what the volatility of a convertible portfolio's risk exposure is really as much an art as a science. I mean, people will show you models where they're telling you that it's clear what your volatility risk is, but that's not clear. Because those of you who are familiar with convertibles often think of them, I think most people think of convertibles as a long volatility instrument, which is in fact true for some convertibles, depending upon where they are. But there's also a significant short volatility component to convertibles. And that is that as the stock drops and the probability of the bond entering distress territory increases, that the convertible bond starts to exhibit negative convexity. So what you have a convertible bond is really a combination of long volatility and short volatility components. The other risk exposure, which is credit, is in many ways more straightforward to understand, but it's much more difficult to hedge. And I think that at our firm that we often do assume different degrees of credit exposure and credit risk, but that is in large part not willing. It's just, there are many times when I would be happy to hedge all of my credit risk, but in the marketplace today, it's extremely difficult and extremely expensive to get that accomplished. With these things in mind, I'd like to focus on what's happened in the market in the past several years. The most significant factor, I believe, that's driven convertible returns is that realized volatility for the past 3 years has almost consistently been higher than the implied forecast was at any given time. And that really is, I think, the fundamental underpinning of what have been really windfall profits for convertible arbitrageurs over the past several years. On the other side of the coin, you've had credit spreads, which for the most part in diversified convertible portfolios have widened out. Now, you would have expected that to a larger extent, I think, to counterbalance the positive aspects of the increased volatility. But in fact, I think most convertible arbitrators haven't experienced that type of effect. I like to think, and I think that we've exhibited it, that because of the problems that convertible arbitrators have had in the past, particularly with credit and liquidity issues, that the world has gotten a lot more sophisticated and a lot smarter and better at managing those kinds of risks. In addition to these portfolio-specific risk factors, there's really, in a macro sense, supply and demand issues. Typically, if you're bringing supply to a market, it will be a bad thing. In the convertible market, strangely enough, supply typically works as a positive. Though there may be more securities coming to market because of the way the market works and the investment banks are bringing these at attractive prices, it tends to be a very significant positive influence. And the past several years, which I'll touch on later, there have been record levels of new issuance of convertibles, which again has been a significant boost to convertible arbs profitability. On the demand side, you all would know probably as well as I do that because of the uncertainty in equity markets, that there's been tremendous demand for absolute return strategies like ours. And there have been many times when we've considered that the most positive aspect supporting the convertible market is the fact that there's been more money coming in. Particularly looked at in recent historical context, when you think back that 1998, long-term capital, what that did was that created a tremendous amount of uncertainty and an increase in risk premiums for any strategy that had to do with fixed income, leverage, and the type of things that we do. And again, much of the return you've seen, I think, in the convertible world is money coming into these strategies, forcing the overall prices up to more normal levels from what were extremely depressed levels back in 98 and 99. Just a more detailed example of how these factors sort of work in a convertible portfolio. I just want to talk a bit about what we did in the past several months. At the end of December, we began to see, the stock market had dropped precipitously in the fall, and much of the telecom and technology issues that had come in the previous year were extremely depressed. They were trading with implied credit spreads, which implied substantial rates of default. This caught our interest. We built a position, but not a significant position. We became more aggressive, building a position and essentially taking credit risk toward the end of the year, when some of the indicators that we follow, particularly things like the high yield index, which in essence I believe reflects the risk premium demanded for these type of spreads, began to tighten. This strategy was given a significant boost by Alan Greenspan the first week in January. What that did was took a significant amount of downside volatility out of the market, I believe, in the short term, which, not to get too technical, but depresses the downside volatility, which increases the credit spreads or makes the credit spreads tighten, which gave our portfolio a tremendous boost, and people like us that had significant credit exposure. At the end of January, we began to get concerned that credit markets had realized much of this increased confidence, and at that point we began to focus upon the supply-demand issues in the marketplace. We knew that there was a substantial amount of money that was going to be put to work in these strategies, and particularly both from the arbitrage community and the outright community, that they would be most interested in better quality investment-grade names. So at that time, we adjusted our portfolio and moved it from the more speculative, credit-sensitive names to the safer investment-grade names. And fortunately, that turned out to be a good move as well, as really it was tremendous demand, despite floods of new issuance to those type of issues. Just to briefly describe today's market, again, our fund is primarily focused in the U.S. Probably 25% of our portfolio is in Europe. We really don't have a presence in Japan. Speaking about the U.S. convertible market, it's extremely unusual. In many ways, it's unprecedented. And what's unprecedented is essentially it's a busted market. And when I say busted, I mean that the bonds exhibit a combination of very high premium, very high credit spreads. There's a lot of uncertainty. Right? And in the past, the universe of investable convertibles in the U.S. was much more diverse. That players like us could pick and choose which sector, whether it's in-the-money volatility names or out-of-the-money credit kind of names that we choose to play in. Right now, if you're a U.S. convertible arbitrager, you do not have that choice. There are very few volatility-sensitive names. Primarily, it's all credit-sensitive names. Europe, of course, is different. Europe, which typically has better credits, is not busted. And what you have there right now is really a bifurcated market in that you have many names where you still do have the securities in the money and you're enabled to do trades where you think you're capturing volatility without taking significant credit exposure. And then there are many bonds that are related to stocks that have fallen significantly. So what you have is convertible bonds that are essentially investment-grade bonds with very little of the equity option components. In the U.S. right now, you have typically much lower deltas, much higher premiums, and what that's resulted in is a substantially decreased amount of leverage in players like us. Now, we had many investors coming to us in the summertime that were very concerned about our leverage. We were levered 8 times. That's long side to market value. I told investors, I watched the leverage and we're concerned about it. But frankly, I think I would much rather have this portfolio than a portfolio that I can imagine where we'd be 2 times levered. Unfortunately, my wish has come true. Or it's not, I shouldn't say my wish, but unfortunately that has come true. Currently we're 2 times levered, and I can tell you that I would much prefer the portfolio we had in the summer with more leverage than the portfolio we have now. Because typically bonds have more premium, more credit risk, they're much more uncertain. A supporting factor in the market, as I mentioned, has been the new issuance calendar. New issuance calendar for the first quarter of 2001 is running roughly comparable levels to what we saw the first quarter of 2000, which, if you remember what the market was like that, it was spectacular. Convertibles really have been the capital structure of choice for corporations that are raising capital right now. I think there was about $22 billion worth of convertibles issued in the U.S. alone in the first quarter. While 2000 was focused on telecom and technology, the range of issuers right now is much more diversified across industries. A structure that's been very popular this year are zeros, zero coupon bonds. These bonds, again, I hope it's not too technical, but they were very difficult to price, and they had many provisions that were unfavorable to the buyers. There were contingent interest payment provisions, contingent conversion provisions, which made these bonds difficult. And I think what we're seeing now is much of those things are going away because the arbitrage community has told the dealer community and the investment banking community that these things are just not what we want to have. Interesting thing about these bonds is that while many outright investors consider them more defensive and more attractive because they typically have higher yields and lower equity exposures, for the arbitrage community, they're in fact less attractive because, again, those type of things when you're trying to hedge create much more uncertainty. I haven't really spoken about Japan. I think the most salient point about Japan right now is the demand-supply imbalance, in that as bonds are maturing, there really has been insignificant new issuance. And, you know, what that has done really, I think that's been the wind at the back of people who have arbitrage positions on in Japan, as those positions have significantly richened. Now, I told you we do not have a real presence in Japan, and there's really two reasons for that. One is just scale. We're a relatively small firm, and we can't cover the globe yet. But more importantly, I feel that Japan is, I wouldn't say it's an accident waiting to happen, but there are significant risks in Japan. And those risks are related, one, to generally elevated levels of the overall convertible market in the face of what's been a generally declining level of volatility in the Nikkei over the past 3 years. In addition, I think sort of the elephant in the room that many convertible arbitrageurs don't want to acknowledge is the callability issue. In that Japanese convertibles, for the most part, are callable. And many of them should be called, but the tradition in Japan is not to call the bonds. And most of the arbitrage community now assumes that they just won't be called. And you know what? They're probably right. But still, I think there's significant risk that if under distress one of the corporates decides that he needs to call that bond, that it could create a cascading effect, and given the leverage in the marketplace, create significant problems. Going forward, I guess the ultimate question is, what do we think of current valuations? And in Europe and the U.S., of course, we're very concerned. You know, the European issues are extremely high, particularly the volatility-driven issues. U.S. issues, you know, are even relatively expensive, I think, driven by the demand factor. There's a lot of money. As Fred mentioned, there's just a lot of money coming into these strategies seeking the 15% return, which looks particularly attractive now in light of what the stock market's doing. Despite the concerns that we have, though, when I look at each individual position, I have to think that the valuations make sense. Regarding the volatility, sure, the implied volatility of these bonds is now at historic highs, but so is the actual volatility. And so is the volatility forecasted by every option market. So perhaps they're not expensive after all. And if you're careful about hedging your volatility, I think that there's money to be made there. Regarding the credit risks, yes, there is tremendous economic uncertainty, and there's a great probability that a lot of these companies won't make it. But that said, I believe you're getting paid for the risk right now. The implied rates of default that are built into the credit spreads would really, are forecasting unprecedented rates of default. Whether that turns out to be true, I don't know. But as I say, I think you are getting paid for your risk. Running short of time here, but I guess no discussion of convertibles is complete without some mention of the cyclicality of returns that have been exhibited. Typically, you know, everyone says every 4 years, like clockwork, you can expect the convertible market to explode. And the question is, you know, can we expect that again? You know, I don't know, but what I can tell you, there are structural reasons for that kind of cyclicality. You know, I don't know if you realize this, but the way convertible bonds are margined by banks and clearing firms is such that as stock prices fall, premium expands, and the clearing firms require more capital to support a given position. So you have a leverage strategy where you have outright players who can overwhelm the arbitrageurs who are keeping spreads in line, and they require additional margins as stocks fall. It's a problematic situation, to say the best. You know, I hope that people have gotten more savvy about protecting themselves and are aware of that risk, but it still lurks there nonetheless. But more important than the conjecture, I have to take some comfort from the fact that the convertible arbitrage's performance in the year 2000. You saw really unexpected and extremely unusual stock price movements to the downside. And if you would have told me going in what a convertible arbitrageur is going to do in an environment like that, I would have expected more significant losses than they actually did. And I hope that is taken as some evidence that the community has gotten much more savvy. So in conclusion, I'd just like to say, are we concerned about current valuations? Clearly, yes. Do we think that the 25% returns that we've seen for the past several years will continue going forward? I would say certainly not. But can funds like ours and convertible our community deliver the 15 or so % that they've promised? I think there's a significant likelihood that they can.
Steve, thank you very much. Paul, you were here a couple of years ago on a panel on risk, and I think you might have one or two things to say about that this time, too.
Thank you for inviting me, Ron. I'll keep coming till I get it right. Since at Elliott Associates we pursue a number of arbitrage and other strategies, Ron asked me to give some observations in general and about each of the strategies. When I was little, my mom told me, if you can't say anything nice, don't say anything at all. So what I should really do is sit here for the next 15 minutes smiling sweetly. But since we have an unusual structure at Elliott, I get paid by the word. I'll just press on. One of my thoughts is that absolute return and hedge funds in general and absolute return specifically is too mainstream now. It's broadening in its interest value to the investing community. Too many new players, new people. It's more than just too much money. It's that people who really are not capable of understanding exactly what they own are pursuing complicated strategies through managers, some of them leveraged strategies, and some of the new investor classes, institutions, endowments, whatever, unless they're very well advised, may find it very difficult to understand if the markets or the strategies have unexpected blips. It's a funny thing. Hedge funds are supposed to be sort of conceptually people standing at the side of markets or the edges of markets, grabbing scraps from the table when nobody's looking. When ARBs and hedge funds become the core owners of some of these markets, and convertibles is an interesting example, because ARBs are generally thought to control that asset class, very unlike 10, 15, 20 years ago, or even 5 years ago. That leads to its own special dynamics and unpredictabilities. So I think hedge funds and absolute return strategies are overdone, and it's more than just too much money. I think when you're contemplating ARB strategies as an investor or as a manager, really, because I face the same kinds of issues because I pursue opportunistically a number of different strategies, so I'm really in your mindset, or I should be. There's an overriding, one overriding issue that I think must always be kept in mind. You should ask yourself, as I do, which of the strategies are really essentially bull market strategies? Which of them depend upon stable to rising stock prices, volatility but not too much volatility, sort of stable credit, sort of trading around a normal range of stable credit spreads, and most importantly, active liquid trading markets. Some of the strategies may have questions, and it's no coincidence. It's not just a coincidence that the growth of the bull market and the growth of leveraged, quantitative, heavily professionally impacted or dominated strategies have all been growing at the same time. And I think there are very few data points when you're trying to contemplate what arbitrage will look like, various forms of arbitrage, in markets that are not characterized by liquidity and not characterized by macro stability or micro stability, and markets that are characterized by desultory trading with widened trading spreads. And I think as I'm discussing some of the individual strategies, it's worth keeping that overarching point in mind. Another point that strikes me about evaluating the risks of arbitrage strategies is I don't know how to put this analytically except to sort of talk around it, and that is when you're looking at the risks or the expected risks of a particular strategy, particularly the ones with leverage, high financial leverage, magnification of notionals or position sizes, I think you have to be careful that when you're assessing the risks of certain strategies based upon historical experience, a lot of times the historical experience you're looking at isn't really the wide and full range of market environments in which that strategy or similar strategies might be tested. You've read too many times in the last few years that the perfect storm has occurred in this asset class or that asset class. It's baloney, and you say, and you hear that this asset class has experienced a 6 sigma event or an 8 sigma event. There were no 8 sigma events except an asteroid hitting the Earth, really. Let's face it. And if you keep hearing that, you know that the models are wrong. It's not that there's an unusual, extraordinary event that will never happen, but the models are wrong, and what the models don't take into account, perhaps, is the impact of highly professional, highly leveraged, passionately and ferociously pursued trading strategies. And you have to think about that, because if movement in particular markets, whether movement of price or spread, breaks out of the boundary of the last 5 or 10 years, some strategies which look solid, and in some of the so-called crises, some of them have been real in some markets, but not that testing in other markets. But if you're looking at the expected boundaries of movement of your manager, your strategy, your particular sector of your portfolio, and the markets move out of those boundaries, I think you're in real trouble, because then you'll be surprised. Then something will look solid up to a point, that is to say a point in movement, and then all hell breaks loose. And when all hell breaks loose in professionally dominated asset classes, the most interesting and important thing we saw in long-term capital is the reason they were not so swift in their assessment of running money as distinguished from the micro patterns of movement of certain securities is that they relied upon their co-professionals, that is to say colleagues, other ARBs, to keep spreads in line. And when everyone is leveraged to varying degrees, nobody was leveraged as they were, able to talk brokerage firms into no haircuts in a lot of assets that they own. But when everyone is leveraged and everyone owns the spread or the position or the asset class, when somebody big gets into trouble, there can be a cascading set of unwinds which radically impacts the capital of a number of the players. I think that's something that has to be thought of in any leveraged asset class, and some of the strategies we've been talking about have that characteristic. It's interesting. Fred made some very interesting comments about merger arb. In fact, we had a merger arb meeting last night, and it's almost as if Fred was sitting at the end of the table, because these factors that Fred talked about were exactly what we talked about. I would simply observe that professionally dominated markets have one set of potentially unusual, strange characteristics, but amateur-dominated markets have other characteristics. One of the things that Fred said, I think, was a function of some amateur domination, that is to say the new players, and he's absolutely right, the volatility of the spreads and the new players. To the extent that markets are professionally dominated, they have the character, or they potentially have the characteristics that I described. Merger arb actually has elements of both, in which whenever deals get into trouble, big trouble or perceived big trouble, like the U.S. West Quest more than a year ago, professional risk management causes the expected boundaries of movement in adversity to be radically, potentially, and actually radically exceeded. You know, if you thought that the downside was X percent of your capital in a deal break, if the situation is professionally held, it's not X. It's not X. It's not only not X, but it won't get to X for a long time, because some people will pursue risk management policies and get out right away, regardless of price, which many times is the right thing to do. But many people will sit there hoping, and so it may take several months to trade right. So, you know, I think a broader point that stems from these points is that the new markets, with so many new hedge funds and players and leverage, contain patterns of movement which, in effect, have never before seen. And the data points that we have for assessing the risks of professionally dominated asset classes and complicated securities and complicated trading strategies is really very little. A couple of comments about specific comments about mergers. You know, the merger business is a great business. It's the quintessent event-driven business. Been around for a while. And if you keep your head and you have low leverage and you're humble and you do work, you know, there are people in it that have been very consistent for a long period of time. To me, it has two characteristics, additional characteristics that are worth thinking about. There's a certain brittleness, as I describe it, to the merger business. It's event-driven. You can see the dates and the event stream. It's finite. You can calculate spreads. People talk about it in terms of spreads. And so that part of it looks very solid. And in most market environments, it is. The reason I use the word brittle is it's solid until a certain point. And that point can be reached in certain types of markets. Certain types of macro environments will radically impact the merger business. And if instead of 1 out of 10 deals breaking, 3 out of 10 deals break, either out of strategic, perceived mind changes in a big bear market move or credit stringency or some other reasons, then that's very impactful, particularly to the leveraged players. So this concept of in what kind of market are you trying to evaluate, stock market and as well as credit market, are you trying to evaluate the risks of mergers? Convertibles are a very interesting asset class. I've been trading convertibles since the early 1970s. It's the classic business that I think of when I question which of these are bull market strategies. There are people that think that convertibles are bull market strategies. There are also people that think that the only tests the convertibles have had were 73-4, in which they very much failed the test, and 1987, in which they were failing the test, but the test was canceled. In 1987, they were failing the test because they traded unbelievably horribly, but the event, the crash of '87, was very horrific and powerful, but over very quickly. And by the end of the year, things had more or less stabilized, and 1988 was fine. It is true that in the 80s and 94, 98, 00, not really 00, but certainly 98, there were periods of tension and spread widening in the convertible market. I do ask myself the following question. People like myself and really a handful of people in the mid-1970s and late 1970s, early 80s were trading convertibles. We didn't have the powerful mathematical tools that exist now. But if you go back and look at what we did, the prices we were paying were absurdly low in today's terms of implied volatility. But you look at the rates of return that we generated, and my 24-year rate of return net is about a little shy of 15%. In the 1980s, when convertibles were 80% of what we did, we were cranking along in the mid to upper teens net. And that's kind of in line with what my peers were doing, Princeton Newport, Tommy Taylor's group down in Texas, some others. Today, the pricing is vastly higher. The convertibles are now dominated by professional investors. And I think that when you look at long-term rates of returns in convertible and the risks of convertibles, there's a certain sense in which you ask yourself, to what extent is the pricing of convertibles and the secularly increasing prices of convertibles accountable for some or a good deal of that performance, as well as the vastly increased amount of leverage that's available to convertibles. Leverage was much lower in the 80s and even 10 years ago. I just want to expand on one point, the credit point, and a small comment on the vol point in convertible arbitrage. The credit point needs a little more flesh on the bones, in my opinion, and that is, in a persistent bear market in which you have not been able to swap out the credit, a lot of European convertible names, you can actually more or less, it's complicated, but more or less sell the credit part of the convertible subordinated debenture to a dealer who will sell it on to an institution who wants to own more, more juice, more fixed income. And you can more or less have a warrant hedge, which is a nice thing to have if things go to zero or the big bear market. You're just having more or less pure volatility. It's a little oversimplified, but that's more or less true. In the U.S., it's not as easy to swap out the credit. If you don't swap out the credit and stocks persistently go down, there's a big bear market, what you find is it's not just that there's a credit component or a big credit component. What you really find is that you're long subordinated debentures with a way out of the money warrant and a very small, by dollars, short position against that bond. So what a convertible ARB portfolio could turn into in a persistent bear market, a ferocious bear market, the S&P is only down, 20% from the highs. The NASDAQ is down, 60, 65%. But it's not a persistent secular bear market yet. We may be in the middle stages, early stages. If you are and you run into a portfolio in which the short position is very small compared to the long position, what you have is a portfolio of distressed, semi-distressed, and junk bonds. The poignant thing about such a portfolio is that, of course, as the stock declines, the next security in the capital structure, and I think Steve referred to this as negative convexity, but the next security in the capital structure, after reaching kind of a bond floor somewhere in the 50s, 60s, and 70s, starts going down faster than the common stock. And so what you have is a substantial susceptibility to the precise credit spread widening that will happen in a persistent bear market. It's something that we have to consider when we're looking at the strategy. We're pretty light in convertibles, and we're only in research names more or less at the moment. But the other thing about convertibles, just a brief note on volatility. Just going back to my brief point about the trading markets, you generally long volatility in convertibles, as a number of other strategies, and if markets simply go quiet, not a crash, not a bull market, but simply go quiet and trading activity lessens, that will be impacted. So I'm not predicting Armageddon in convertible arbitrage. There are some very highly professional, highly adept players making money because they're trading the stock around the time deals are priced, the underpricing of deals, trading around their positions. But these are things to keep in mind. Let's see. Just sort of an overview of, if you listen to me talk this way, you might say, gee, is he invested just in treasury bills? The answer is no. We find things to do to keep our people active and keep them off the streets. But what I think is efficacious, and maybe particularly efficacious, as the markets are changing, the macros are changing. They're not as predictable. They're rapidly the bull market is over, or it appears to be over. What is productive to me is humility, opportunism, to go to opportunities like Fred has very nicely identified in certain subsectors of the merger markets, other aspects. But this notion of the powerful growth of professional traders and arbitrage specialists and how they impact the pattern of movements of securities has to be a core part of the decision making. And going with the people that are somewhat more humble, somewhat more less leveraged, given any particular set of parameters, less aggressive, I think is functional. Lower return, you can't get something for nothing. Less leverage, less notionals means lower return, but it means lower risk as markets continue to change and develop, and that's what we see going forward. Thanks, Ron.
Well, thank you very much. Any questions or comments? Yes. Actually, John, wait for the microphone to come around here so we can capture you for posterity.
Thank you. This question is best directed to Stephen and Paul with regard to credit default swaps, credit default hedges. How confident are you that they'll protect you in downside tail events? In other words, how great is counterparty risk?
Well, at Sagamore, we have not done any default swaps as of yet because we don't have the confidence that the market will work. We feel that it's too immature a market, and we just don't feel comfortable. We've been doing quite a bit of the asset swapping that Paul mentioned, which I think is a more straightforward transaction that has more of a history to it. And we're comfortable, and we monitor our counterparty risk. We think that there can be some mark-to-market issues with an over-the-counter instrument like that, which we account for, hopefully, in our risk scenarios. But in the end, we feel confident that they will protect us as we had hoped.
I would echo those thoughts. We don't do the credit default stuff, but we do asset swap, and we do think that more or less gets rid of the credit and will protect in a big credit spread widening.
We only get one question this time.
Okay. How about an observation?
Please.
Before a question. To Fred, actually, the observation is this. Aside from the guns and hoses crowd that show up at Opal, the level of sophistication on the endowments is getting much better because they have alumni from the various community, Wall Street community, that are sitting on board so that they understand the strategies. And that's one thing that's changing. I agree that there's more investors from the endowment side, college endowments, particularly in the asset class. But that's one thing that's changing. The question actually is for, I guess, a brief question to Fred. I noticed on page 3 you have a tremendous amount of strategic investors versus financial buyers. Interesting article in the Wall Street Journal talking about the fact that some of the busted companies, particularly the internet space, where there's more cash on the balance sheet than actual market cap. Does anybody play in that lower part of the market in terms of merger arbitrage, and takeover at all? And then secondly, Steve, you mentioned briefly there's an article about busted converts as an interesting play, given the issuance of telecom paper. And is that something that's attractive to you now?
We've invested, I guess, in the last couple of years in a half a dozen deals involving internet companies. And, my background before I got into arbitrage, I was a fundamentalist and a portfolio strategist. And people would ask us, well, why are you, long this company that's trading at 50 times revenues, and we'd say, well, because we're short this company that's trading at 80 times revenues. We had the spread hedged, and we've had pretty good success there. We don't do any speculative investing, however. I'm not trolling for companies that might be good takeover targets in the internet space or anywhere else. If their deal's announced and they look attractive, we'll play them. And I think there will be a lot of activity involving busted companies, internet companies, and tech stocks. There was a very significant acquisition that was closed within the last month that I think it's worth paying attention to because it might foreshadow similar transactions. Siemens, the big German electronics conglomerate, bought a U.S. company called Efficient Networks. Efficient Networks makes hardware for DSL systems. Efficient Networks, at the height of the mania for companies, internet-related companies, traded at over $150 a share. Earlier this year, it traded down to 10. Siemens always coveted their technology, but wasn't going to pay multiple billions of dollars for this company. They came in and offered $23 a share for Efficient Networks, over 100% premium, but I think they felt they were getting good value. And I think the carnage in the tech sector is going to lead to a lot of merger activity when the dust settles.
Ron, could I make a comment on that? Please. On that Wall Street Journal article, which made the point that some companies are trading for so-called less than zero because of the cash. What the article didn't point out, and it struck us because we know some of the companies on that list, was that many of these companies, perhaps most of them, are bleeding cash like crazy, and that cash is ephemeral. It'll be gone very, very soon. Tremendous negative cash flow. So that's something that has to be taken into account if you think you're buying something at zero.
No, just briefly. No, just briefly. We've been very active in the busted convertible sector. We would rather not be, but given what goes on in the market and that most people are not comfortable trading those type of things and they really are in uncharted territory, that we feel that, with skill and effort that you really can add value looking at those situations.
We always rely on this thought-provoking question. I'm just giving you a hard time.
One of the ARB strategies that we have not heard about today, although we've certainly seen a lot of it in the press, is the private placement convertibles or the Reg D strategy. So I wonder if either Steve or Paul have anything to say about that asset class.
We have a segment of the portfolio devoted to private structured convertibles. The issuance of those things has generally tailed off because corporate issuers generally think that they have too great a negative impact on the stock price. The protective features that make them so interesting, the resets, the floating conversion prices, the discounts, the bells and whistles, are focused on too quickly by the marketplace, which really runs ahead of, in effect, the arbitrageur or the owner of the security, and thus some of the stock prices have come down very, very hard. So it's not really a factor. In other kinds of markets, it may come back, but some people, I think, have been pretty unhappy with their recent performance in that area.
No, we're not active in that sector for a variety of reasons.
Well, if there are no other questions or comments, we'll wrap up in a moment. First, I wanted to turn over to Steve for any announcements.
I want to apologize to everyone for last month. We tried to hold a session on technology, and no one wanted to show up. No one wanted to go on record, so sorry about that. It's amazing how they want to come here when they're on the upside. I'd like to thank Bill Quinn from Goldman Sachs specifically for helping us put together today's panel. Thanks, Bill. Bill's sitting to the left of Paul. And I want to especially thank Vencast for webcasting this out to those foundations, endowments, and alternative investors who couldn't be here today.
Just to wrap up, I'll paraphrase our friend, the Nobelist, again, and I wish you all pockets full of nickels and your paths free of steamrollers. But thank you again for coming.